Most people think beating the market is about being smarter. It's not, it's about not being stupid. Consistently, because here's the truth, 90% of investors lose to something a robot could do for free, and today, I'm going to show you the 7 rules that quietly crush the market, while everyone else keeps chasing noise. There are 2 types of investors. The first one checks prices every day, they jump in. They jump out, they chase trends. Panic sell. Buy hype, they feel busy, they feel smart, but over time they fall behind. Then there's the second type, they look boring, they move slow, they ignore almost everything, and somehow, they end up richer. Same market, same opportunities, completely different results. So what's the difference? Back in 2008, during the financial crisis, there was a guy, average income. No insider knowledge, he had 2 choices: sell everything like everyone else, or keep buying while the world was falling apart. His friends told him he was crazy, news channels screamed collapse. Experts predicted years of pain, but he followed a simple rule: buy when it feels uncomfortable. So he kept investing, month after month. Fast forward 10 years, his portfolio didn't just recover, it multiplied. Meanwhile, his friends, still waiting for the perfect time to get back in. This is where most people fail. They think investing is about timing. It's not, it's about behavior, and behavior is controlled by rules. So let's break down the 7 rules that separate winners from everyone else. Rule number 1, stop trying to beat the market, own it. This sounds backwards, but it's the foundation of everything. Most investors try to pick winners, stocks, crypto, trends, but the data is brutal. Over long periods, most professionals can't beat the market. So what chance does the average person have? Instead of fighting the market, own the whole thing. Broad index investing. It's simple, it's boring, and it works, because instead of betting on one company, you're betting on progress itself, and historically, progress wins. Rule number 2, time in the market beats timing the market. Everyone wants the perfect entry, the dip, the crash, the once in a lifetime opportunity. But here's the twist: missing just a few of the best days in the market can destroy your returns. And guess what? Those best days often come right after the worst days. So if you panic and sell, you lock in losses and miss the recovery. That's a double loss. The real advantage: staying in, even when it feels wrong, especially when it feels wrong. Rule number 3, automate everything. Willpower is unreliable. Emotion is expensive, so remove both. Set up automatic investing, every paycheck, every month, no decisions, because the more you think, the more you interfere, and interference kills performance. Automation does something powerful: it forces consistency, and consistency beats intensity every time. Rule number 4, ignore the noise. News is designed to grab attention, not grow your money. Market crash, recession fears, hot stock of the week. It's all noise, because if you zoom out, the market trends up over time, but zoomed in, it looks like chaos. Most investors live zoomed in, they react to headlines, they chase stories, but the best investors, they zoom out, they understand one thing: short-term noise is the price you pay for long-term gains. Rule number 5, volatility is not risk. This is where most people get confused. They think, market down equals danger, but that's not true. Volatility is movement, risk is permanent loss. Those are not the same thing. If the market drops 20%, but recovers later, was that risk? No, it was opportunity. Real risk is selling at the bottom, never investing at all, or putting money into things you don't understand. Volatility feels scary, but it's actually the reason returns exist. Rule number 6. Play the long game. Most people underestimate time. They want results now, this year, this quarter, but wealth doesn't work like that. It compounds, slow at first, then suddenly fast. Let's break it down. Year 1, nothing impressive. Year 5, still feels slow. Year 10, now it's noticeable. Year 20, it's life-changing. But here's the problem, most people quit before year 10, they get bored, they lose patience, and they reset the clock. Over and over again, the winners, they just don't stop. Rule number 7, behavior beats strategy. This is the biggest one. You can have the perfect strategy, but if you panic, chase, or quit, it won't matter, because investing success isn't about knowing more, it's about doing less. Consistently, let's compare. Investor A reads every book, follows every trend, changes strategy constantly. Investor B picks a simple plan, sticks to it, ignores everything else. Who wins? Almost always Investor B, because discipline compounds, and emotions destroy. Now here's the part nobody tells you, these rules are not hard, you already understand them. The problem is, they're boring, and humans hate boring. We want excitement, we want action, we want to feel like we're doing something. But in investing, action is often the enemy, doing less is the edge. Think about this, if you follow just these 7 rules, no stock picking, no timing, no constant checking, you would outperform the majority of investors, most professionals, even some hedge funds, not because you're smarter, but because you're consistent, and consistency is rare. That's the real secret, not intelligence, not luck, but discipline over time. So here's the question, are you trying to be right? Or are you trying to build wealth, because those are not the same game? If you want to win, stop chasing, start systemizing, follow the rules, stay in the game, and let time do what it always does. If this changed how you see investing, watch the next video, because what most people believe about money is exactly what keeps them poor.